$1. That's what $10,000 sitting in a traditional big bank savings account will earn you in an entire year. Not 100, not 10, $1.02 if the account is generous. And here's what makes that number genuinely dangerous. While your savings account was generating that single dollar, inflation quietly consumed 3.8% of the same $10,000. That's $380 in purchasing power gone without a single withdrawal, without a single financial mistake on your part. Your money didn't stay the same, it got smaller, and the account you trusted to protect it was the one holding the door open. You're responsible with money, that's not in question here. You save even when it's hard, even when it would be easier not to. You have an emergency fund sitting somewhere untouched, waiting for the day you actually need it. That discipline is real. It took something to build that cushion, and you know it. But there's a version of financial responsibility nobody warns you about. The version where you do everything right, you save consistently, you don't touch the money, you feel like you're covered. And still, quietly, invisibly, your savings lose ground every single month. Think about a tire with a slow puncture. You don't feel it at first, the car still drives, nothing seems wrong. But with every mile, the tire loses just a little more pressure until the exact moment you need it to hold, it doesn't. Most people's savings accounts have been running on a slow puncture for years. And the bank isn't going to call you about it. What I want to walk you through today is a specific type of account, a high-yield savings account that doesn't just stop that slow puncture. It actually restores the pressure automatically every single day, regardless of how much you earn or how much you have inside it. It's fully FDIC insured. It requires no minimum balance at most institutions. It costs nothing to open and nothing to maintain. And about halfway through this video, something is going to shift in how you see the money sitting in your current savings account right now. Once that shift happens, it tends to stay. Here's exactly where the puncture is happening. Traditional savings accounts at the major banks, the ones with branches on every block, the household names most Americans grew up with, pay around 0.01% APY on standard savings. The national average isn't dramatically better, sitting around 0.38%. The best high-yield savings accounts available right now pay between 3.75% and 5% APY. Put real numbers on that gap. $10,000 at 0.01% earns exactly $1 per year. $10,000 at 4% earns $400 per year. Same money, same zero effort. A $399 difference, not because of any investment decision, not because of any financial sophistication, just because of where the account lives. But year one is only the beginning. That $400 gets added to your balance. Next year you earn interest on a slightly larger number. Daily compounding, which most high-yield accounts use, means the gap doesn't stay flat. It widens. Take the average American emergency fund, somewhere around $8,000. At a big bank savings account, 5 years of responsible, untouched savings earns you about $4 in total interest. At a high-yield savings account compounding daily at 4% APY, that same $8,000 grows to approximately $9,700 over 5 years, without a single additional deposit. That's $1,700 created from money you already had, not from risk, not from timing the market, from opening a different account. Now this isn't new information. The gap between traditional savings accounts and high-yield savings accounts has been this significant for years, which raises the real question: if the math is this obvious, why don't most people switch? 3 reasons, and each one feels like caution. The first is what behavioral economists call status quo bias. Your brain treats your current account as the baseline, and any change, even a 10-minute change, registers as introducing risk. Staying put feels safe, but inertia isn't the same as protection. It just feels identical. The second is what I'd call the proximity illusion. That branch down the street, the ATM in the grocery store, the logo you've seen since childhood, it all feels like physical security. But FDIC insurance doesn't care about branch proximity. A high-yield savings account at an online bank carries the exact same federal government protection as your neighborhood institution. Up to $250,000 per depositor per insured institution. Same coverage, zero difference. The third is familiarity, the app you've had on your phone for a decade. The bank that opened your first account. Familiarity feels like trustworthiness. But a familiar account paying 0.01% on your savings isn't loyal to you. It's profitable for them, and you're financing that profit with your inertia year after year. Now here's the shift. Most financial content frames high-yield savings accounts as a wealth-building strategy. Move your money here, earn more, build wealth. That framing is why people delay. This isn't primarily about building wealth. It's about stopping the bleed. Inflation running at 3.8% annually. Your big bank savings at 0.01%. That's not neutral ground. That's a net purchasing power loss of nearly 3.8% per year, silently applied to every dollar in that account every month it sits there. A high-yield savings account at 4% APY neutralizes that loss almost entirely. You're not getting rich. You're sealing the slow puncture that's been quietly deflating the financial cushion you spent years building. That's not a minor adjustment. That's the difference between your emergency fund slowly eroding in real value every year and it actually holding its ground. Automatically while you work, while you sleep, every single day without asking anything more from you. Let's make this concrete with one more number. Someone keeps $20,000 in emergency savings at a big bank for 5 years. They do everything right. They're disciplined. They never touch it. They're proud of what it took to build that cushion. At the end of 5 years, they've earned roughly $10 in interest. Meanwhile, inflation quietly removed approximately $3,500 in purchasing power from that same account. That's a car repair they would have had to put on a credit card. A medical bill that would have emptied the account down to nothing. The exact kind of emergency the fund was built to absorb, and it can't absorb as much of it as it should. Not from a bad investment, not from a financial mistake, from a slow puncture they didn't know was there. So what does the fix actually look like? High-yield savings accounts are offered almost exclusively by online banks, institutions that operate without thousands of physical branches. That lower overhead translates directly into a higher interest rate passed back to you. The FDIC insurance is identical. The federal protections are the same. The only structural difference is where the margin goes to their balance sheet or back into your balance. Opening a high-yield savings account takes about 15 minutes. You don't close your existing bank account. You don't change where your paycheck deposits. You link the new account to your current checking, set an automatic transfer for the amount you've designated as savings, and that's it. From that moment forward, your emergency fund earns real compound interest, calculated daily, credited monthly. The slow puncture seals, the pressure holds. And for the first time, the money you set aside for an unexpected bill, a job loss, a crisis you can't predict, it's not just sitting there. It's working its way to being slightly larger every single morning than it was the night before. That's what financial protection actually looks like, not a promise. An architecture built into an account you can open before this week is over. When you move your savings to a high-yield savings account, something quietly shifts in how you relate to your money. Not because you suddenly have more, because you stop passively losing what you already built. There's a specific kind of calm that comes from knowing your emergency fund is earning while it waits, not just sitting in the dark, hoping nothing happens before you need it. That $8,000 that was earning 80 cents a year, now it earns $320, then $340, then more, compounding daily automatically without asking anything additional of you. That's financial security, not the feeling of it, the actual working architecture of it. But I want to leave you with something to sit with. If your savings account has been running on a slow puncture for years, what else might be leaking? The high-yield savings account is the simplest fix, the fastest win available in personal finance, the one where the math is impossible to dispute and the action takes a fraction of an afternoon. But every dollar sitting somewhere below its potential is a slow puncture somewhere else. Seal this one first, then look around, ask the question again. Your financial security doesn't come from earning more. It comes from losing less, automatically, silently, starting right now. If this changed how you see your savings, hit like and subscribe. There's more coming on financial protection that most people in your situation have never been told this directly.